Alrighty, so I have put together a little slide deck about DeFi, a brief introduction. If some people, I'm sure we've got some people amongst you who are absolute DeFi pros, and then some people who are like, I don't really know what this stuff is. So let's start with just what is decentralized finance, or DeFi for short. My working definition of DeFi is custodianless financial products, lending, borrowing, securities, and derivatives, built by many different teams on a public decentralized ledger that users are able to move their assets seamlessly between. And what this basically means is custodianless financial products means that when I put the assets into a financial product, like let's say I am lending my assets out, or I am doing some kind of swapping arrangement, the asset itself is being held by a smart contract rather than by a company. Built by many different teams on a public decentralized ledger means that there's this single fabric underpinning everything else, that many different teams are able to get involved, that they're able to build on the same fabric. And so what you get is this last bit, which is users are able to move their assets seamlessly between, which is one of the really key magic points of DeFi, because now, instead of having to go from a company to a company where each company I have to do this massive onboarding process, I can essentially take an asset from one financial product and move it instantaneously to another financial project built by a different company, built by a different team, built by different developers. And I can do it seamlessly because it all exists on the same underlying fabric, a public ledger like Ethereum or Radix. Now, a really simple example of this is the London Stock Exchange and the Shanghai Stock Exchange. This is the old school method of doing things. If you think about owning some stock on the London Stock Exchange, and you're like, hey, there's some stock on the Shanghai Stock Exchange that I really want, and I'm fully allocated. So what I need to do is I need to sell some of my stock on the London Stock Exchange to be able to buy something on the Shanghai Stock Exchange. Now, in the old world, the idea of being able to swap stock A listed on this London Stock Exchange for stocks B listed on the Shanghai Stock Exchange is sort of meaningless as an automatic operation, right? There's this concept in financial systems called atomicity. It's actually a database concept, but it means that you do two things at the same time, and they have to both succeed or both fail, right? And banks use this all the time. If I am sending money from my bank account to someone else's bank account, you want mine to be debited at the same time as the other is credited, and you don't want to end up in a situation where I have not been debited and they've been credited, because you end up creating money. But on top of the existing financial architecture that we have, there's these little islands of finance. And so London Stock Exchange is one of the islands. And I can't go stock A to stock B as a single instant transaction. I have to actually go into cash. So I'll go to the London Stock Exchange, I'll sell my stock, I'll go into cash, I'll then move the cash from the UK to China, and then once it's finally moved from China into China, I will then deposit it on the Shanghai Stock Exchange and buy the stock. Now, fundamentally, that's a very slow and relatively broken way of doing things. And it kind of works and big for the average consumer, but it sort of is broken in many fundamental ways. So what can DeFi do? In theory, it can kind of do anything that currently exists in financial services. And the main use cases that we're seeing are things like lending and borrowing. We're seeing derivatives. We're seeing automated market makers. We're seeing insurance. We're seeing assets. We're seeing automated investing. And this is because a public ledger is like Ethereum or like Radix, allows you to program anything that you want to be able to build on top of that ledger, including building financial products, being able to change an asset from one type to another, or being able to lend it from one place to another, or provide it as yield, or be able to repurpose it so that it goes from, say, for example, Ethereum to a stable coin if I'm using something like MakerDAO, and this is what I call the next layer of the money layer cake. So that we started off in crypto with going, how would we describe decentralized value? And that's where things like Bitcoin and stuff like that came out. And the key around that was that it was able to be programmed. I could suddenly do if-then statements around it in a way that I didn't have, that users could use it instantaneously and frictionlessly. So there was no AML process, there's no KYC process, there's no registration process. Essentially, if you have a public-private key pair, you can interact with the system. And it's similar to what made the internet powerful, was this frictionless way in which you could suddenly interact with it. I just need an IP address to be able to interact with the internet. And so the first thing we did was this decentralized money. Now, once decentralized money had been created and the value had built to the point where that value made sense to start repurposing it for other products and services, then that programmability became even more powerful, because you could start to make if statements, and you can start to make full programs around what would happen with that value. And that's where we're starting to see some of the early products that are coming out of this. And there's a lot of benefits that happen here. Like, ultimately, users should see better returns on their money, because they have a wider amount of choice. In theory, have a wider amount of choice. If I build a product on top of a public ledger that is a DeFi product, its audience is global, and it's global instantly, because all of those people who already hold value on top of these public ledgers can move their assets, if they choose to, into these decentralized finance protocols, into these decentralized finance products instantaneously. And this gives them a better choice. Now, this does also mean that there are problems around this, and I'll go into sort of the things like the scams and the bugs and all that kind of stuff. But as a result, you also have less friction between moving assets. If you think about, if anyone has ever had a pension fund, a company pension scheme, and tried moving between company pension schemes, or consolidating your assets, or moving bank accounts in certain countries, or indeed, as I was giving before, moving money between brokerages, or if you have a trading account in America and a trading account in Asia, and being able to consolidate those two and actually use those assets as a single basket, you'll understand how complicated money can get. But fundamentally, what DeFi is providing is this single underlying fabric that allows you to move assets frictionlessly between these places that are offering you different opportunities for that money. And that ultimately also gives users more choice, because you are getting to the point where you have multiple competing the only thing that's really stopping money flowing into a decentralized finance application a lot of the time is its competition with others on the same fabric, which is great for the consumer, because it creates all of this competition to create better and better products that can very quickly be spun up and money can be deposited into. And this is fundamentally, these three things is what Radix really focuses on, and this is why we focus on the DeFi industry specifically. But this concept of access, liquidity, and choice is fundamentally what drives DeFi, and what we're getting this huge growth in the DeFi space out of. So there's also some really interesting, unique aspects about how DeFi works as well. One of the key innovations is this concept called the constant function market maker, which, if you ever want to sort of go down the path of understanding like how simplicity and elegance can actually end up being it can end up with interesting innovations. But Uniswap has $1.3 billion of liquidity locked in it. And unlike normal market maker functions, if I look at how a centralized exchange like the London Stock Exchange or like Coinbase or any of these places work, market making is a professional activity. What people do is they come onto the exchange and they make sure that the spread between the buy and sell of a stock that's trading is nice and tight. But to do that, you constantly have to be moving your buy and sell orders often on the book as the price moves up and down. And that's quite a complex, in-depth operation, which means that market making and liquidity provision is generally done by professional organizations. In DeFi, suddenly it's become crowdsourced, community-sourced liquidity, which is being provided by people who can just put their assets into these protocols like Uniswap, and the protocol automatically makes a market from those assets for the users. The users earn fees from doing so, but don't have to be professional market makers. It essentially takes 3 clicks to do this. And then you also have the same thing in automated lending protocols. Like $1.52 billion of assets are currently right now being lent out in Aave. And the people who have things like Ethereum or wrapped Bitcoin or any of the sort of ERC20 tokens that are out there are earning $1 million in fees a day for lending out their collateral. But they didn't have, all they had to do was have a MetaMask wallet and visit the Aave app interface, and they could deposit and start earning instantly. And that is really powerful. This programmatic 24-hour finance is really powerful, and it's powerful because because automation sits at the very heart of it. So all that sounds fantastic, right? Obviously, there are some challenges. The first challenge of this is gas, which is what Ethereum's word for transaction fees are essentially. So during the August and September, there was a huge DeFi boom, and Ethereum essentially just got stuck. And it's got stuck before. Like we've been in the situation in 2017, and like it really hasn't moved on from there. And it was costing like upwards of $100 just to interact with DeFi applications, which was a problem for the little guy. And the reason that I think that's so key to DeFi is because for me, crypto often talked about this concept called the unbanked. It's banking the unbanked, which I really dislike as a concept, because it feels like a very like rich country, poor country divide thing, which I think isn't what crypto is about at all. I think that crypto is about equality of opportunity, and so this idea that you can get into DeFi even with like $5 or $10 or $20, and you can start playing around with products and services that just would be completely not available to you in your country, completely out of your access because you didn't have enough funds to be able to put it in. You need a minimum of $50,000 or $100,000 to put it in the equivalent in the centralized financial ecosystem. But the Ethereum gas costs are still making it very expensive to as someone who doesn't have a huge amount of money to actually interact with it, which for me is killing one of the core things, the things that excites me about DeFi. Now I call this about accessing the underinvested, and I think the underinvested can exist anywhere. They can exist in England and America as much as they do in Nigeria and Ethiopia and Vietnam. And I think that's what DeFi is. That's what this is ultimately about, is an opening up of opportunity to everyone. And the other challenges that we got here is smart contract hacks and bugs, like this concept of YOLO and wrecked. Like YOLO, people probably know it means you only live once, but in DeFi it means throwing a large amount of money into an unaudited decentralized finance application, because you make most profits, normally most returns, if you get in early when the price is low. But often it turns out that the project itself wasn't properly audited, and there's some kind of bug, and you end up in situations like Yam.finance, which had $220 million flow into it and then flow out of it all within the space of 4 or 5 days. And the BZX hacks, where there was this dependency between smart contracts, which ended up meaning that like $25 million was stolen. And this is a fundamental problem again with Ethereum and Solidity, which is the Ethereum development environment, which is causing these developers to make these horrible choices of being like, I need to get to market quickly because I need to take the opportunity as quickly as possible, but as soon as I go to market, people don't respect like beta testing or anything. They just put large amounts of money in and things go wrong. So the way in which Ethereum has been built to code and program on top of the Ethereum ledger is also really problematic for DeFi as well. So how is DeFi doing? It's doing very well, up and to the right, as everyone likes to see. In April, so January, we're about 300 million. April, we'd sort of raised to 800 million. We had a little blip. June, we went to 1 billion. August, 4.2 billion. September, 10 billion. October, 11 billion. And now we're at $14 billion dollars of assets, crypto assets. These are still crypto natives. So like things like wrapped Bitcoin, things like Ethereum, things like ERC20s that are created on top of these ledgers, but assets nonetheless that have real exchangeable value are being locked in these protocols and making real money for people. But we are still seeing these underlying problems. Ethereum transactions are back to their all-time high. You can see these spikes here, and this is how much it's costing people to use Ethereum, which is kind of insane. And like, you know, the maximum gas fee yesterday, someone paid $190 just to do one thing on Ethereum. And in the last 2 weeks, someone paid $2,513 just to do one thing on Ethereum, which is a really expensive cost. So this is sort of holding back the DeFi industry. And this was a problem when CryptoKitties, I don't know if anyone remembers CryptoKitties. It was 2017, which in crypto years is eons, but it was this amazingly popular gaming application that users all wanted to come and breed these kitties and then get the kitties out. And fundamentally, it caused the same problem on Ethereum: huge gas prices, lots of congestion, people struggling to get through. But now we're in a whole different ballgame, because in 2017, the problem was user to smart contract interaction. And that's what people thought what public ledger was all about. But in 2020, what we're actually seeing, what product market fit is for decentralized finance, what product market fit is for public ledgers, is application to application interaction. It isn't the fact that I as a user can do one thing with one financial application. It's I as a user can do many things with many financial applications, often simultaneously and often layered on top of each other, where I can have one smart contract that's speaking to multiple other DeFi smart contracts to create more and more interesting, helpful, and better designed financial applications. So if you look at like what's happening as transaction volume on top of ledgers today, you can see how much of these operations are actually occurring between smart contracts as well as from a user to a smart contract. And that's really is the crux of this, because we've ended up in this weird situation where the thing that is driving DeFi growth is composability, this ability to stitch together all of these different financial applications and create wonderful sort of liquidity and opportunity for people. And the way that you can describe composability is basically this train and hotel example. I want to go on holiday. To go on holiday, I'm going to book a train and a hotel, my favorite hotel. But if I can't get a train ticket, I don't want to book the hotel. And if I can't get the hotel, I don't want to book the train ticket. This is a very simple idea of composability. That's what is right at the heart of DeFi applications working with each other. But the problem is that every single public ledger has come along and gone like, right, we're going to solve this with sharding. We're going to cut the blockchain up into lots of different subchains or subnets, and we're going to let applications be on lots of different shards to increase the throughput. But then it breaks composability. And this is true for Ethereum 2.0, which is going to break DeFi composability. It's true for Polkadot, it's true for Avalanche, it's true for Cosmos, which is what's so interesting about what is going to happen with the DeFi industry over the next 2-3 years, because fundamentally the solutions that people built, that they designed from the lessons in 2017, hey, we need user to application scalability, just aren't actually true about what makes DeFi special and what makes it powerful. So we're going to see some really interesting changes in the industry, I think, in the next 2 to 3 years. And obviously that's what Radix has been built specifically for. We built our layer 1 specifically to serve DeFi. And to do that, we really did 3 things. The first is make sure that we didn't break composability in how we scaled. Number 2, made sure that it scales linearly. And number 3, make sure that it works with multi-ledger assets, which means that basically we don't mind where the assets are coming from. We just need to make sure that as many assets as possible have access to this ecosystem to get you into this place where you have as much interoperability of assets, of users, of financial applications that's possible, that creates all of this wonderful innovation that has been driving this huge growth in total assets under management in DeFi to today. So if you want to find out more about Radix, please do go to our website, radixdlt.com. You can email us at hello@radixdlt.com. You can also get me on Twitter at Piers Ridyard, and you can get us on Twitter at radixdlt. And with that, I will hand you back over to
All right, Piers, many thanks. Your enthusiasm about the DeFi scene is mind-blowing. I've been sitting here being completely silent and listening to your story. It's very, very interesting to hear actually what DeFi is about, but especially what are the next steps in the scene also in the upcoming months. We've seen all kinds of concepts. We've seen gas, we've seen Polkadot, FOMO solutions, and so forth. But I'm just curious to learn. We have a majority of our listeners at home are Dutch citizens. Right now, if you don't have shares or big amounts of money, why would I enter the DeFi space, according to you?
I think there's some macro trends that are coming down the line. That are really interesting, like the COVID is going to have a massive impact, has already had a massive impact on the global economy. It still hasn't had that much of an impact on the share price for whatever reason. I think much of that is being sort of propped up by the huge amount of monetary printing that's going on. But fundamentally, we are already in a situation where my money in a bank account basically gets me 0% per year, and the returns on the stock market, we believe the returns on the stock market are going to go south pretty quickly, pretty soon, and that there's going to be this continued amount of economic malaise that occurs in the main markets. Like there's been a lot of talk about crypto being counter-cyclical, and like it's yet to prove that out properly, but a lot of these decentralized finance applications that are allowing you to get yields of 5, 10, 15, 20% on just stable coins, right? So if I've just got some USDC, or if I've just got some DAI, I can earn 15% a year just having that on a lending protocol like Aave, or putting that into something like Compound.
Instead of like the negative interest rates that Dutch banks are currently, offering between brackets.
Exactly. So I think that in the immediate term, where this is going to come out of is the continued building of anger about what the traditional financial system is providing to the everyday person, and an easier and easier pathway for people just to be able to go, well, if I just take my money here and I change it into a stable token. So no speculation on the value of Bitcoin or anything like that. I just change it into dollars, USDC, and then I put it into this protocol. I earn money. Now, obviously, there's a lot of depth and complexity underneath that. Like, why is there money? Where's the yield coming from? Like, why is my money safe? Why is it not going to disappear tomorrow? Like, it still feels like magic. Like that's the thing that a lot of the everyday person is going to have to get through and get over, and get to the point where they start to trust that that is actually really 15% a year. No, there's no catches here. You just need to make sure that you join this new financial ecosystem. And if you get in there now, the rewards are actually pretty high, because there is so much activity that's happening. There's so much economic activity and innovation that's happening. There's actually providing legitimate yield, not like Ponzi yield.
It's of course very important that we say that we are not offering any financial advice at this event. So always at home also check where you're putting your money in. I mean, there have been a lot of scam projects, unfortunately, also in the DeFi fields. It was interesting what you mentioned. The upcoming year will see, the effects, of course, of the enduring corona crisis, also in the financial atmosphere. We've seen, of course, the rise of stock prices. Some people argue that like the money printing of governments actually increased prices of crypto assets. So there's also a positive note on that for the owners of cryptocurrency coins. I'm curious to learn from your side, what do you see in the upcoming year happening in the DeFi space? What are you the most interested in? What are you most enthusiastic about? What will happen in DeFi in 2021?
So I still think that DeFi is quite a niche area. So like what I'm excited about will feel quite niche. Like it's niche because it sort of sits at the crossroads of technology and finance, and both are already relatively niche areas. Like the thing that I'm seeing as a macro trend within DeFi is a market-driven, liquidity-driven way of pricing risk. And it's completely different to what is being done in the financial system today. So if I go to Goldman Sachs and say, hey, I want you to price me an option or a forward, or I go to JP Morgan and I say, hey, I want to borrow, the way that they do that is not a market-driven approach. It's essentially they go and run some spreadsheets and they go and like have their own internal models. But what DeFi is doing is it's changing the way that risk pricing and what is offered to people is done via market-driven pricing and liquidity-driven pricing. And that's already hit for things like the constant function market maker. It's already hit for things like continuous lending protocols like Compound and Aave. But I can see that down the road, it's going to also be affecting things like options and derivatives. And like that part of the market is huge, like hidden from most people, but huge. But it's important because it means that you get better hedging projects and products, and you get better ways of de-risking. And that, I think, is going to be key to then fundamentally packaging up things that consumers can actually end up being safe with. Like if you can de-risk something on a high volatility with a better risk pricing model for options, you end up getting to the point where you can get nice consumer products that are sort of hide all of this complexity underneath. And that's what I'm excited about. Like there's still a load of building to go. Like we're still not all the way there, but I see good consumer products that have come out of the DeFi ecosystem in like the next year, 2 years as a result of this better pricing mechanism.
And I really can see the enthusiasm coming from your face. It's like here in Amsterdam, we can like see the energy flowing into our study. Piers, Ridyard, thank you so much for your contribution for now, because you will stay with us for the upcoming session, the panel discussion.